Hello, everyone. I am Mark Gatto, co-CEO and co-founder of CION Investments, and I'm your host today for the Advisor Lab. And we are truly fortunate to have on the show today Jason Wenk from Altruist, who's just doing some amazing things in the financial services space. Jason is actually a repeat guest on the pod. He was here back in 2020. I don't know if you remember that,
Oh yeah.
Jason. So early days when you were building this incredible platform, this incredible franchise. I'm glad that we had the foresight to have you on at that time, and now bringing you back after so much success in the business that you've had. And when I heard that you were joining us today, I kind of smirked a little bit because I feel like most people, probably including myself, think of the custodial business as kind of like this, boring traditional business where you safeguard assets and do some administrative tasks and trading. But I think you've been able to quite well take a different approach and bring tech to it and make it interesting. And I think that's one of the most important things that you've been able to accomplish, and especially in our business, in investments, alternative investments, financial services. There's a lot of old tradition that needs to be relooked at and taken a fresh view of. And I don't think anybody's done it better than you. And to think about doing it in such a space where there's just two behemoths to compete with in Fidelity and Schwab is pretty incredible. Either you were or are crazy, but I think that craziness is what makes great entrepreneurs. So just maybe start out and let's talk about kind of what you saw at the time, and what you think needed to be changed, improved, and how you sort of thought about competing in this space, and what you saw was wrong with it.
Well, thank you for the great introduction. And yeah, it's wild. It's been over 5 years,
Yeah.
since we chatted. I think I've aged at least 10 in that time period. So the crazy part is probably true. Building a custodian is not for the faint of heart. And interestingly, I think especially because of the approach we took. So kind of you pointed out, like custody at its core is kind of boring. It's holding assets, clearing transactions, reconciling corporate actions, posting tax documents and trade com firms. I mean, these aren't exactly like the world's most exciting things to do, but they're critical. Like you have to get them right. Requires actually flawless, execution. So it's not something you can be 99% right. You have to be essentially kind of, NASA-like precision on these things. So that in and of itself is hard. And then on top of that, we want a bunch of things different and better. And so, most specifically, we wanted to make it a lot easier for advisors to be able to serve clients. So whether that was the onboarding process, make that lightning quick and all digital and highly automated, or getting money into accounts or sending money out to clients, how can you do that? And again, a fully digital way, remove the need for DocuSign envelopes and processing paperwork, and kind of wondering if you send something off to a custodian home office, like how long will it take to process? Why not just make it real time and kind of on your phone type of thing? And then make trading also a lot simpler and more effective for people. So take fractional share trading, essentially makes it kind of the notion of like managing money for a client with less money versus a very large account is kind of irrelevant. We took what was already like boring but important, and then we like expanded the surface area to just a whole bunch of user experiences. And I'll just say like most of the genesis to that was I ran a large RIA before I built Altruist, and so if you're running a pretty good size firm and if it's growing fast, every small inefficiency, friction, like its most simple example would be like if someone's only adding 5 or 6 new clients a year, it's really not that big a deal. In fact, if you had to do the paperwork by hand with pen and paper, it's not that big of a deal. You do 5 of them in a week and you kind of go, okay, it's a little bit more of a pain. And, perhaps DocuSign is helpful. You start doing 50 a day and you're like, it's not even possible, to do it the old way. Like you have to have a much more efficient way. And then the same thing is true with like serving clients, right? If you have 100 or 200, you can kind of get away with a lot of things being inefficient, but once you have 50,000 or 100,000 or 500,000, I mean, there's zero margin for inefficiency and lack of automation. So, that doesn't mean that smaller firms shouldn't also have all of that, but that was, the personal pain I felt kind of running a reasonably large, fast-growing RIA, gave me enough signal that we needed to rebuild the infrastructure of custody.
Wonderful. And what would you say your inspiration for doing it was? Did you model yourself after another business in the space? How did you kind of figure out what you really wanted to do in terms of how do you implement all those things that you just talked about?
Of ideas they come from your own personal needs. And so if I just kind of thought, so even if you didn't have an inspiration, you just kind of thought in first principles, like what should account opening be like? And, how should I be able to invest client money? I mean, you probably wouldn't do it the way that it was done before. Like we just accept it as these are the limitations, these are the laws of gravity, if you will, like in our industry. So you just accept those. But I will say, like, I definitely took some inspiration from Robinhood, although I have a lot of critiques of their business these days. I'm not a big fan of
Right.
like, putting gambling inside of your, long-term investing app.
Right.
So those things are not very inspirational. But again, I'd say sometime, in the mid 20 teens, so probably around 2015 or 2016, Robinhood really started to take off. And I remember opening my first Robinhood account myself just to kind of feel the experience and, basically downloading an app on your phone, opening an account, transferring some money, and then being able to invest like $5 in, a stock that has a $300 or $400 share price, doing the whole entire thing in under 2 minutes, paying no commissions, all digital. And you're kind of sitting there going, wow. Like, but yet as advisors, we're talking about, DocuSign as like the big innovation. We're still at that time still paying commissions. Everybody's still trading whole shares. You're having to tie together 5 or 6 different softwares in order to make a firm run. Again, Robinhood, you could just run on your phone. I was
Hmm.
sitting here going, I think we might be a little bit behind here on the advisor side. Like we might want to evolve before we get, eaten alive here. And so that was definitely, kind of one of those moments that made me get off my ass and go do something about it.
Yeah, it's amazing, right? It's amazing how you can learn from other people in the space what they're doing and apply it to something that you think there's a problem. And in terms of you mentioned no commissions at Robinhood, and that was a big deal, I think, when they first launched. I assume you're doing something creative on the revenue side, right? You're probably doing something that's maybe not as traditional, or you're giving more value for what advisors are getting. Can you talk about your revenue model and how you approach that part of the business, how potentially it differentiates you from the others in the space?
Sure. Yeah. I mean, I think first thing is that I always knew that commissions were a bit of a farce. It was kind of one of those funny things where if you studied publicly traded, brokerage firms, um, especially those that were B2B in nature, so they were serving advisors and not necessarily like active traders. Commissions were a negligible percentage of their revenue. But it kind of gave advisors permission to say, hey, we use, whomever, TD Ameritrade as our custodian, and they do all these wonderful things for us, and it's only $7 a trade. And like the people would hear that and they would assume that's how TD Ameritrade makes money is $7
Hmm.
a trade on equities and ETFs. And then if you actually looked at their P&L, you'd find that actually that was, 10% or something or less of their revenue. And they were actually kind of high, like in terms of the transactional revenue was a higher portion for them than it was for other brokerages. Most were probably closer to 5%. And so really, giving away commissions just means you lose, I don't know, 5 to 7% of revenue. And you could make that up in a lot of different they just have a terrible trade execution, right? So if you look at the best execution reports, which everybody has to publish with FINRA, so these aren't like, mystery documents. They have some of the worst execution you could ever get, right? And so why? What's the result? Well, they get larger spread income between the bid and the ask. People call this payment for order flow. They're mostly selling those trades to liquidity providers, Citadel, Virtu, et cetera, et cetera. And so, they figured out a way to make more money effectively by not charging commissions than charging commissions at all. And then, they built a product that had a lot of products that still have very, very juicy, commission structures. So like options trading is 30-40% of their revenue, probably closer to 30% today. Crypto is like 30%. Again, these are things that are very expensive actually to trade. So it's kind of like a little bit smoke and mirrors where a lot of folks would say this is commission free, but then there's these other things that they just make a ton of money off from, right? Now, in the case of an RIA custodian, it is a bit more of a scale business. Advisors are more, I'd say calculated in their trading. They're going to predominantly hold very low amounts of cash. If you look at, again, like a great proxy for people is if you look at Robinhood as a public company, they have something like, 15 to 20% of all assets at Robinhood are in cash. That's a lot of cash to be holding on a relative basis. Whereas if you look at an advisor portfolio, it might be like 2.5%. And so we hold way less cash than they do. So you're not going to make 150 or 200 or 225 basis points like an active trader consumer product. For an advisory product, yes, you make money on net interest income. So there's a spread on cash. Same thing on margin. Like there's a cost to access liquidity, a price you mark it up to. But I can tell you that all of these things are very thin, right? Like it's very skinny. If you can make 20 to 25 basis points, like that would be industry leading revenue for an RIA custodian. I think it's not fully disclosed. Like they don't bifurcate like the retail versus RIA, but all of the things I've heard is that Schwab, for example, runs at somewhere around 12 or 13 basis points is like how much revenue they generate. So it is a pretty interesting business. So where it works, like how you make it work, especially for a company like Altruist, is much more around automation and efficiencies, right? So you're not necessarily going to drive new revenue by getting rid of commissions. What you have to learn how to do is do a ton of things with no humans involved. So can we open accounts 95% of the time with all of the KYC and AML and CIP? Can it be fully automated so no human being ever has to review almost every account that gets opened? Can we do the same thing with ACAT transfers? Can we do the same thing with trustee to trustee retirement account, kind of rollovers, transfers like that? Can we do that with check deposits, right? So if all of these things can be done with very high degrees of automation, even things like customer support and service, like we're the first custodian to ever roll out chat-based support and AI-based support. And right now it's something I think around 30% of all support requests that come to Altruist are handled entirely automated with AI. Now, I say this to say that like these are the reasons why we're able to go out and do things other custodians can't, because we have operational efficiency that they don't. We don't process paperwork. Everything's done digital. We're able to do service at scale and still do phenomenally well in terms of our SLAs, kind of the speed at which we respond to people. And we have a net promoter score of 70 right now. So, it's a beloved product by its customers. It has nothing to do with how we generate revenue, but yes, we do make net interest income. We have like 12 or 13 revenue lines that are all like razor thin, right? They're all like very, very, small, 1 or 2 basis points here, there, they kind of roll up. And the business again functions largely because we're able to operate with an efficiency no one else has.
Right. So you've been very successful raising capital for the business. It's a tough environment. I'm in the capital raising business, right? We manufacture alternative investments and we try to raise capital around them, and it's a very competitive market. I have some personal experience with some startup firms and trying to raise capital. Very difficult to do. You've been very successful, and I'm curious to know, what have those investors seen in you, and why do they think this is such a big opportunity for them? Because what I just heard, like in some way or fashion, is like, well, you have operational efficiencies, but nothing like that spoke to me in terms of like the big upside. Like where's the big upside? What are they seeing? What are you pitching in terms of how you're changing the industry? So because I think that's got to be the hook, right? You're going to change the industry in some form or fashion, and
Yeah.
ultimately, if not displace, be a thorn in the side of the big firms.
Yeah, so I should say like so we've raised I think around $615 million, which is definitely non-trivial. I mean, it's hard to build to build this, so it is something you have to be able to raise capital. So how see, I mean, I think there's a few things. One is, they want to see the size of the market. Like, could this be a 10, 20, 50, $100 billion public company, perhaps? And so if you kind of work backwards, in RIA custody today, it's probably around $10 trillion in assets. I mean, Schwab just in their last quarterly earnings reported that they surpassed 5 trillion alone in RIA. And the RIA segment is growing, depending on which report you want to believe, but let's just say that it's growing north of 10%, somewhere maybe between the 10 to 15% range. You have like market tailwinds. You've got essentially a one-way street. Nobody ever goes RIA, then goes back to a wirehouse or goes back to a broker dealer. Like, this is kind of once you go here, you stay here. So it's not like unreasonable to say, well, over the next 10 years, how big will this market be? And if it goes at, again, even a 10% clip, it's going to be 25 plus trillion dollar market. As you pointed out early, two companies have over 80% market share, Schwab and Fidelity. And again, good companies, great long-term reputations, but not necessarily nimble or innovative or digital first. Perhaps not incredibly appealing to the next generation of advisors or end clients, where you're going to see trillions of dollars move to over the next 10 to 20 years. A third of the entire industry will be retiring in the next 10 to 15 years. So, again, where does Altruist fit into this? Well, reasonably good chance that we'll be highly competitive with those two companies over the next 10 years. So how big could we get, right? Could we get to 10% of that? Could we get to 2.5 trillion in 10 years? Even if you're only making, 20 basis points, that's a lot of revenue, right? So that's a very big company. That's probably $100 billion public company, right? So, there's the first kind of like, rubric, when an investor is looking at investing is like, how big could this become in the event that they're able to succeed? Editors do they have? Like, who are they competing against? Like, how much, how many other challengers do they have to outpace? In our case, the odds of somebody catching us from behind are not particularly good. It's hard to do. It's capital intensive, right? So it really, I'd say today, it looks like, it's us, Schwab, Fidelity. There might be some other potential players, but they're not really highly relevant today. So it's then a matter of, can we execute, right? So size of market, check, right? Like this could be very, very big. Interestingly, we also built a vertically integrated platform. So we could earn 2 or 3 or 4 times as much revenue as a custody-only platform. We have software, we have a killer AI product, we integrate asset management, tax management. So we've just done a bunch of vertical integration. So we're not really only competing as a custodian, we're also competing as SaaS, enterprise SaaS provider. We're competing as an asset management distribution partner, right? So there's a lot of kind of additional revenue lines we'll have that other custodians don't have. So not only is the size of the market huge and our automation really good, which means we'll have insanely good gross margins, and likely higher actual revenue on assets, right? So ROA or ROCA, some people call it. So once you kind of have that piece, then the next thing is, well, do you have the right team to do it? And that, I can only say that, when I started the company, so I didn't really put all this together until after the fact, but I've now learned a few things, like what do they look for in terms of like a founder that's capable and a founding team that's capable. I was 38, when I started the company. I think, again, now looking back in hindsight, that's about the right age. If you're going to go after a really monster market like this, it's really tough. Like, it's not easy if you're 20 years old. Having been in the business for 15 plus years was actually an advantage, but I was still young enough to go hard after a big opportunity. We were able to attract incredibly talented people, many from outside of our industry. So when you look at like the founding team, our chief product officer, our COO, our CTO, like these people are unlike folks that have been in this space before, right? So like our CTO came from Coinbase. Before that, he was Uber. Before that, Meta, right? Like these aren't folks that have traditionally come over and decided to build, RIA technology
Right.
and platforms. So I think it was kind of like, is the size of market there? Is the quality of the team the right team to go after it? And I think those two things are what allowed us to get access to some of the early capital. After you have the early capital, then you have to actually go do something with it. So is there actual product market fit? Do people care what you're building? And so we pretty quickly got to 1,000 customers, and 2,000. Today we have 5,500 plus, growing really quickly. So all along the journey, there were these milestones that suggested, you know what? It turns out like that this is a big market. This team seems to be executing pretty well. The actual results are there. Now, as a later stage company today, we're really treated like, almost like a public company. I mean, like when an investor comes in to do their diligence on Altruist, they're looking at our revenue, our gross margin, our EBIT margin, kind of what kind of operating leverage, what are our unit economics, what will this thing scale to? And they literally comp us to like LPL, and to Schwab and to Robinhood. So when we see the comps, like that's kind of where we're being comped against. And so you do have to have a real business. It can't just be like big market, interesting founder, quality team. It's like, once you're 5, 6 years in, you better have 5, 6 years of pretty serious traction in market. So that's a bit wordy there, but gives you an idea of like, in the early days, look, if you're not going after a big enough market, and if you don't have
Right.
a founding team to believe in, hard to get money, and but even if you have those things, like again, each step along the journey requires, sort of a different expectation from investors.
I love the team that you put together because it really is the people that make the difference. And if you want to disrupt an industry and be creative in an industry that has historically not been that creative, you need people from different backgrounds and outside of the circle, so to speak. And I think that's probably one of the best things you may have done to get this thing rolling, and why you're experiencing such great success. When we talk about the advisor, is there a particular advisor that gravitates to you? Is it just a newer, younger advisor who doesn't, believe in sort of the way of doing things in the past, or is it people that are truly, not 100% happy with their experience? Like, what type of advisor are you attracting? What does their profile look like?
Yeah, I mean, about a third of our new users are breakaway advisors.
Hmm.
So they're going to either be coming from a bank wirehouse, or they're already independent, but like BD channels, they're coming from, LPL or say Cetera, et cetera. And they're just going RIA, right? So about a third are there. And that's pretty consistent with like, I think a lot of the logo growth in the industry. Like there's not as much lateral movement as people believe. Like in other words, like how many people are really going from Fidelity to Schwab or vice versa? Probably not that many. It's more about, can you win the next new account? Can you win the new entrants? 20 years ago there were only 3,500 firms. Today there's almost 40,000 firms. Even with all the M&A, like there's still more new firms being born every year than there are being bought. So we're still adding a net, 6, 7, 800 new firms every year. That's after the hundreds of firms that get bought and like consolidated and rolled up. So there's just a lot of, kind of inbound. Um, the other two-thirds are existing RIAs. I mean, these are folks who they are added to other custodian for one reason or another. They're either unhappy, their economics aren't good. It could be that they're just growing really fast. They want to add another custodian. So we're being added as a second or a third custody option. And it's interesting. I would say that the size of firms is pretty vast. Like in this year, we added, I want to say it was like, north of 20 multi-billion dollar firms this year. And so some in the early days, they might say, well, doesn't Altruist mostly work with, startup small advisors? And yeah, I mean, look, in our first 2 years, you have to build something and go to
Sure.
market where you can, meet the needs of a customer. Today, our product's much more, robust and enterprise grade. So, some of our fastest growing segments are large firms. And those firms, they oftentimes will use us for a segment of their customers. So it could be, hey, I just want all of my sub $2 million accounts in Altruist because it's a way more efficient platform with more automation. It could be, I want to have a next gen team. So like we've actually seen this where you'll have let's say a team of 10 or 15 advisors. They take two or three younger advisors within their broader group,
Mm.
put them exclusively on Altruist, kind of serving their next gen clients. Doesn't always mean those people are small. Like there are 35-year-olds out there that have $10 million, believe it or
Yeah.
not. Yeah, right. So, or more. And so there's some of that. There could be, folks that want to have like a hybrid offering, meaning like a digital kind of like efficient, lower cost, service. And then they have like a private client, high net worth service, right? And we become a segment of one of those. So there's all sorts of different reasons, but the common thread is that the firms we tend to work with are growing. And if you're not growing, you feel very little pain in this industry, right? So like
Mhm.
if someone has, 100 families they serve and they're already onboarded, you don't plan on adding any more. You've already invested the money for the most part. You're doing very menial kind of rebalancing and service work. At that point, you probably feel very little pain. Like you've done most of this stuff. Those folks have very little reason to ever change, and that's totally okay. But if a firm is like going from 100 families they serve to 500 families, those people tend to be on Altruist. So like the organic growers, they end up here. And that doesn't matter if they're like a $50 million firm on their journey to 200 or a $5 billion firm on their journey to 20 billion, right? Like if their intention is that is mostly going to come from organic growth, they're working hard. They want to be able to efficiently kind of not just onboard, but serve with like really attractive operational efficiency and margin. That works really well here, right? So
Right.
it is interesting. I mean, again, of the 5,500, it's probably 50% still are state registered advisors, that are
Mhm.
under 100 million in assets. They tend to use this as like an all-in-one solution where they're only custodian. They use us for custody, asset management, performance reporting, fee billing, the whole gamut. All the way up to we have firms that are tens of billions of dollar, very large firms, and they might just use this for like $500 million of their total assets, right? Like a smaller segment, and they may be using us primarily as a custodian. In other words, like they're still centralizing their trading on Orion or Adapar or some other third party.
Mhm.
That's who's doing their performance reporting and fee billing, and they're using us as like a modern custodian, so to speak, but not necessarily an all-in-one solution. So that gives you some idea. The only other thing I'd add is like, our AI product, which is called Hazel, is the one thing we do that doesn't require you have an Altruist account. Like it can be used by any advisor. And very, kind of surprisingly, 40% of the Hazel customers have no relationship with Altruist at all. Like they're on a totally different custody platform, not using us in any way, shape, or form, like on the custody or software or asset management side. And so I find that to be kind of interesting, right? Like that there's
Mhm.
this whole other segment of people that have exposure to Altruist via our AI products. And they're only using the AI products, and that's totally okay with us.
And
That's why
that's a
we kind of made
separate
it,
relationship. It's a separate
yeah,
fee
separate
associated
login.
with it and so
Yep.
forth. And I wanted to ask about the tech stack because I assume, especially with the younger advisors, the tech stack is probably really important and a differentiator. What sort of things are you doing there that enable you to attract the advisor, especially the younger advisor who's growing and leans into tech, not only in their business but in their daily lives?
Yeah, I mean, I think if anything, the the thing I see a lot of Ultras users do, which I am really glad to see, is they keep their tech stack, if you will, incredibly simple. So,
Mhm.
they might only have like a single financial planning tool, a CRM, Altruist, and like G Suite. And that's it. And they're totally efficient and they're killing it and they have very little distractions. Toggling between a bunch of software or like if you're trying to serve 100 different client personas and so when I see someone who's like, well, I use this software for advanced financial planning, this thing for tax planning, this thing for retirement income planning, I'm like, that sounds like you have a lot of clients that aren't the same, so you're not really niching into anything, you're just kind of serving whomever. And as a result, one, you have to use a lot of different tools, but even your brain has to context switch all the time between these different things that you're doing. That's really hard. So what's been really cool is to watch certain firms really consolidate, their vendor stack, if you will. So they might be like, again, that very lean tech stack, but also a very lean kind of set of portfolios, right? So that maybe they work with your firm, Altruist, and like one ETF vendor or something like that, right? Like they're able to have meaningful relationships, even if they're not necessarily large firms, because they've kind of consolidated. The end result for clients is a more efficient, unified experience anyway. Advisors are more efficient. They're spending more time on the things that matter and less time, again, kind of context switching. They don't have to have staff trained across five different platforms. And, so it's an interesting kind of, mix. And yeah, the things that the Altruist platform can do out of the box, I mean, really well is all of the things a custodian can do: open, fund, trade, manage accounts. But we built in, really elegant performance reporting. Our mobile app is the highest rated mobile app in the entire industry. So end clients can, easily see what's happening. They can do all of their account openings, attestations, move money back and forth between their bank, like all on their phone, just with a couple taps, really, really seamless. We have integrated fee billing, model-based trading. So advisors can build and manage their own models and models of models. So sort of like a UMA structure. We just released today, actually, something called Review and Release, which makes all of that trading real time. And pretty sophisticated. So like you get to basically in advance, our optimizer will run over all of the positions and tell you very precisely what will happen from like a tax perspective across each client account, allowing you to kind of analyze and review, release, kind of those trades out to market. So in other words, very sophisticated trading and rebalancing software, it's fully integrated. So those are some of the things, right? And again, it's what's kind of wild is, back when I started in 2004, my first RIA, if you wanted to have all of that, first of all, it's not even possible to do this stuff 20 years ago, but like hypothetically, if you wanted to have sophisticated trading, with like the most efficient kind of a client onboarding and reporting, you're talking like, I don't know, $50,000 of software fees and for still a pretty, fragmented user experience. And today you can sign up with Altruist, no minimum. You could have one client with like $100 in the account and have essentially like a $50 to $100,000 software stack totally free. So it's pretty cool what's happened in this industry, in that efficiency scales with the firm. So the other thing that happens is, people that are maybe they have a unified platform is because they are paying a TAMP, I don't know, 50 basis points or something. They come over to Altruist and they're like, holy cow, I can save $1 million, or something absurd. So the unified kind of integrated stack is appealing both to like big firms that have bloated, expensive, hard to operate stacks, but also like startups basically can day one just have an incredibly robust, offering for their clients that looks super expensive, but it's totally free, just integrated into their
I
custodian.
like that as your new marketing campaign. Save $1 million with Altruist.
Some of it's pretty ridiculous. I just talked to an advisor a couple weeks ago. He's paying like a third party platform. I think he said 25 basis points. He's got about 200 million of assets, and so he's paying them $500,000 a year. And like could replicate that exact same business on Altruist, and the entire $500,000 comes back to him. Right now, that's kind of crazy. Then you start thinking about multiples firms trade at, and it's like these
Mhm.
firms that are trading at, I don't know, 8 times EBITDA, and you go, that $500,000 is also worth $4 million of actual enterprise value.
Right.
So when some people make the move, it's like it's overwhelmingly obvious and objective, the benefit to them. It's not like we're trying to sell something hypothetical, like, oh, hypothetical, imagine how much time you'd have back. It's like the easiest sale in the world. When you sell to advisors, I've always kind of told my team, it's not that advisors are greedy or lazy, but if you want to get them motivated to do something, they want to either make more money, work less hours, or both.
Right.
You know, if you're just kind of doing one or the other, it's still pretty compelling. But man, when you can do both, like show them like, hey, cut 10 hours a week worth of work and add $500,000 of earnings to your firm's bottom line, like your close rate's very high.
It's
These
compelling.
are not hard sells. Yeah.
It's compelling for sure. So, a couple questions, and we can wrap this up. Curious about the name, the genesis of the name, what it means to you, and how it permeates your culture and your mission.
Yeah. So great catch. Yeah. I bought the domain name before I started the company. I'd been thinking about, I'd been thinking about, kind of different businesses that would fit the name Altruist well. Yeah, I knew I want, my last company was called Formula Folios, so it was a bit more of a mouthful. But our kind of slogan, if you will, was we said that we were an investment firm with an obsession for doing good. And we had this kind of mantra that we do good in three ways: in our community, in our industry, and for each other. And we had very specific kind of KPIs as far as what that meant. So as you can say, I've always been a bit of a mission-driven founder. I want to do things that make a difference and impact. If you can make it a good business, fantastic. But like, you have to have some sacred rules about caring for customers and trying to build a culture that matters. So anyhow, the name, that was something I'd kind of kicked around for a while. Like I've always felt like an altruist is someone who truly puts others before themselves. A
Mhm.
fiduciary is very similar, considering someone else's interest before your own. So I felt like they were very aligned. I've been very passionate about serving the RIA community for over 20 years. So very much lined up there. And then it is definitely part of our culture. I mean, the mission of Altruist is to make financial advice better, more affordable, and accessible to everybody. We do that by building a software and integrated custody solution that makes advisors way more efficient than they are today. Um, so all these things, like they're not definitely not by accident. Like there's definitely sort of a sort of concentric thinking that's been going on for a decade, kind of planning, tinkering with mission, serving the RA community. All those things felt very natural then when I wanted to start this company that I was going to call it Altruist, and it was going to be designed to again serve RIAs, and the end result would be that advice gets better, cheaper, and everybody can get access to it.
That's great. So to wrap it up, what's the next frontier for Altruist? What's something you're really excited about that we can see coming in the future?
Well, I mean, uh,
Not that you haven't done a lot already, but
yeah, no, I mean, I have some big plans in 2026. I mean, I think so, one kind of simple answer is like, the use cases and efficiency gains from AI have been remarkable for us internally. The gains we're seeing from customers that are using them are pretty remarkable. So, over the next year, you're going to see Hazel just deeply integrated into everything we do. So it'll be all across the core Ultras platform. Like we're already doing deep custodial data integrations. It'll become very agentic in terms of things you'll be able to get Hazel to do for you that'll replicate human work. That'll be pretty exciting. Um, we'll be launching a new business line next year, so I'll just kind of tease it that I'm very excited about it. So it's probably my number one area of focus right now. And the new business line is very specifically designed to help breakaway advisors be able to go independent faster, more efficiently, less risk. And so we'll be kind of launching that pilot early next year, probably sometime in mid 2026. We'll go public with it, but it's definitely occupying a lot of kind of brain cycles for me right now, and I'm really excited about what's possible in terms of our ability to impact the industry,
Mhm.
yeah, kind of shake things up a little bit. So every time we do something here, our general view is like, can you make something 10x better? Like that's sort of the order of magnitude we aim for. So if it's a cost savings, can we do this 90% cheaper than anyone else has ever done it before?
Mhm.
If it's like a speed thing, can we do this again in 90% less time or 10 times faster, right? Depending on which axiom you want to use. And so I can assure you, like, yeah, if we're tinkering around with something, if we just can't find a way to make it 10x better, we probably won't do it.
Mhm.
And this is why we haven't gotten to things like CRM or financial planning. I just can't, I don't see yet a world where like somehow those tools can be made easily, objectively, obviously 10x better. Whereas like things like account opening, that was easy, no brainer. If we can take something from 30 minutes to 2 minutes, like we've made it 15x better. Um, so what other things can we do that? And I think there's a few in particular that I'm pretty excited about over the next year, where we'll launch products and it will just be, again, very little thinking required. People will go, wow, this is again obvious, it's objective, and it is 10x more better than the rest than anyone else has done it in the industry. So we'll do fewer things in the future, but those things should be pretty high impact.
Wonderful. Well, it was a real pleasure to have you on the Advisor Lab for a second time,
Thank
and
you.
I look forward to having you on a third time to hear about your continued success and some of these projects that you have coming in the future. But thank you again.
Thank you so much.
All right.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without CION Investments' prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither CION Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. CION Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of CION Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.